So much more to come on this second part of day 3 of the Sustainable Investment Forum North America 2021. We've got a panel addressing sustainable infrastructure investing, how infrastructure investors are contributing to SDG outcomes, engaging the private sector in a green recovery. Are investors in private infrastructure assets better able to meet climate targets and achieve risk-return objectives? Let's get over to Rick Walters, who is Chief of Standards and Innovation at the Global Real Estate Sustainability Benchmark. Rick, I'll hand the floor over to you.
Thanks very much, and very great to be here. I'll just give you a quick small correction. We're known as GRESB or GRESB these days, so we don't go by the real estate spelling out of the acronym anymore, as many of these kind of organizations do. So and I guess that brings me to what we are. We're the global benchmark for ESG for real estate and infrastructure, and we've been doing that for 6 years in infrastructure and 11 in real estate. And very glad to be here today and moderating this session with a fantastic panel. I'll just go around the panel in a moment through the questions, but just to briefly explain, we've got Megha Lakhchaura, who is Director of Policy and Utility Programs at EVBox North America, François Bergere, who is the Executive Director of the Long-Term Infrastructure Investors Association, Paul Shantic, who's Director Inflation Sensitive at CalSTRS, and Sean Kidney, who's the CEO of the Climate Bonds Initiative. A great panel today, and as you sort of started to allude on the topic, it's a pretty big topic with a lot to unpack. So let's get straight into it with some questions. And as I bring the speakers in, please, if you do want to introduce yourself a little bit, then take that first question. I refer to you as an opportunity to do so. I think that'll keep it flowing nicely. So a lot to unpack, but we might start with something kind of local to North America. The infrastructure bill is of great interest to infrastructure investors. I think there are many that are hopeful around what that might lead to. But how much private capital might that crowd in? Is there still public resistance to private infrastructure investment, and is that a barrier to progress? Maybe we start with you, Megha, regarding that in terms of the policy side. What would you say that it looks like from a policy perspective?
From a policy perspective, and I can speak more specifically to the transportation electrification part of it, it's a $1 trillion bill, and around $7.5 billion is allocated towards EV charging, and another 7.5 goes towards towards buses and truck electrification. In terms of like private capital, this is not going to build all the chargers that we need in North America. When the president came out with this plan, he talked about $15 billion to build 500,000 chargers. If we were to support 30 million electric vehicles in this country by 2030, we'd need closer to 3 million electric chargers. And with this current infrastructure, we would get nowhere near that. So this in no way would crowd out any kind of private investment. In fact, what it would do is attract more, because one of the biggest challenges why people don't buy cars is that they don't see chargers around. And once you put in that initial set of chargers, like they've done in Europe, people go ahead and buy EVs, which in turn increases utilization, which in turn would lead to more private investment into chargers. This is a good start. It's not enough, and let's see what happens on Thursday, because right now it's still in the House, and it's not done till it's done. So we're very optimistic about it. But other than that, also in the reconciliation bill, which is not part of the infrastructure bill, there are some great incentives for both electric vehicles as well as chargers. You could get huge tax rebates ranging from $7,500 to $12,500, depending on the model of car that you buy. And then with chargers, you could get a 30% tax credit, which is capped at $200,000. So this infrastructure bill, coupled with the tax benefits, could really boost EV adoption next year. And with the tax credits, more cars on the road, we will see much more private investment into the infrastructure part of electric vehicles.
Great. That makes a lot of sense, and I can see how some government investment towards that kind of infrastructure would really make an opportunity for private investment. That's a nice explanation. Or just have my lights go out. These things happen. I might ask you then, Paul, from a broader perspective. You're involved with a wide range of infrastructure. What's your kind of view on the potential for the bill and crowding in private capital?
I'm usually kind of a wait and see sort of person in regards to how money from Washington gets into the system. I think we were talking earlier that there's always a potential. This is a good thing. I mean, it brings light, shines a light on infrastructure. But as money gets distributed, it's a question of how a state or a city that gets those funds, what they do with it. In a lot of instances, I think what we find is that they'll put it into their budgets and look to spend it as quickly as they possibly can to repair roads and do things like that. I think I've always been of the opinion that there's plenty of money in the United States that would love to do infrastructure. The question is how that gets used. And what we find in the United States, of course, is that we have a fairly active and broad muni market that can issue bonds for projects that are occurring at the state and local level. Financing in terms of infrastructure along the lines of like LaGuardia terminals and things like that in public-private partnerships are hard to do. They take a long time to do, and there's a number of entities that are particularly good at it, but getting that down into a city or county level in the United States is much more difficult because of the kinds of processes and people that you need in place to be successful doing those projects. There's plenty of examples in New York with the Port Authority have a good record of doing those sorts of things around the airports and various other projects that they've got. So it depends on kind of what the project is and what you're going to do. And then, just because it's infrastructure doesn't mean it's going to be something that California State Teachers is going to want to look at, because my approach and our approach to infrastructure is a little bit different. It's, modest capital appreciation. We're looking for an income stream, and we're looking. We're not private equity. We're not going to be building, for example, looking to build charging stations and hope that folks are going to come. I'm going to be coming into a project like that after it's been built and there's some sort of track record with it. So that might be more private equity oriented for sure. And I think private equity probably would certainly look at those sorts of things to package the projects up and get them going. So that's our approach to infrastructure. So just because it's infrastructure doesn't necessarily mean that every pension fund that has an infrastructure portfolio is going to be attracted to public broadband in rural areas. We're going to be looking closely at what is the payback, what's the cash flows look like, how secure are they for infrastructure for us, and how we define it and how we work with it. Some of this stuff may be much more private equity oriented, and sort of being able to ask those questions to figure out from either a pension fund or other investors as to what kind of risk they're willing to take on some of these things. I think probably the critical question that individuals need to ask themselves when they're looking at these projects, and people are looking for a home, trying to do a project, maybe with monies that come out of the infrastructure bill.
Yeah, that probably takes us on to our kind of next point, and I'll keep you going for a second, Paul. The definition and the purpose of infrastructure in a pension portfolio. You struck on a few things there. The risk return profile is, something that's fundamental to investors in infrastructure as they define it, right? As pension funds define infrastructure. That might be quite different to how an engineer, how a constructor, how the public defines infrastructure. Where, sometimes I feel like we can be talking about actually two completely different definitions, which is kind of interesting and a little bit odd sometimes, it strikes me as. But anyway, it's the way we invest. So just broadening that out a little bit, does that definition and purpose drive the investment, and then things like investments in climate solutions, both mitigation and adaptation? can they be considered infrastructure? And then does it even matter? So maybe Paul first, and then I'll start to bring the others in on kind of different approaches around this.
I would tend to think that again, when I'm an investor, right? So I'm going to look at things as, how secure does that cash flow look to me? What's the value of that investment? Do I think that it will appreciate over time in the way that I think? I'm not looking to hit home runs. I'm not looking for 25, 30% return. That's my equity colleagues and to some extent sometimes my real estate colleagues that can do that. I'm sort of slow, and I'm kind of like the tortoise in the group. I'm slow and steady. We want to continue to produce income, some modest returns with not a lot of risk involved. We have an ability to do some opportunistic things in our portfolio, but they're usually tied in with an expansion of a current project and things like that. Also, you have to remember too that not every investor, in terms of the hurdle rate that they're going to look at an investment, some may actually have a low hurdle rate. It may be 4 or 5%. They may be fully invested. My hurdle rate is probably going to be a little bit higher because as a pension fund with liabilities that are going to extend out a number of years, we're going to might be looking for a higher return than other people are, and other funds. So that's kind of a real critical part of this too. If we look at a number of different proposals that come in sustainability, we have renewables in our portfolio, and have had that in for the portfolio for a number of years. So really what's going to drive it is, every investment is a story. And some of those stories are easier to get your head around, and you can see them and you can understand them, and there's some experience with them. Depending on who you're talking to and what their experience is, you may end up in a lot of sustainable type investments as they begin to develop over time, having to tell a story over and over and over again, but having examples that actually demonstrate that the security of the cash flows or the security of the kind of of cash that's going to be coming in that can be distributed to investors. And it's not always something that's obvious, to an investor. And it may not give them the returns they're looking for. They may be much lower returns. And that may be something that I'm just not going to be interested in, but another pension fund or another investor might decide to lever those returns differently, or maybe approaching it from a more capital appreciation angle, sense of capital appreciation than I might here at CalSTRS. So understanding who your investors are and what your investment can produce for someone like either me or someone else, and then trying to slot those investors into the conversation is probably going to be the most important thing for anybody doing work in the sustainable investment area.
It's a good message for those who are going to be knocking on your door and others' doors, of course, Paul. I might bring in Sean here. So Paul's highlighted some of the challenges there and around really talking the investor language and pitching in the right way to the right investors as well, and the right departments within the investors. What do you think about the kind of role of blended finance and other approaches? I think we've been mainly kind of focused here on equity so far, but in terms of mobilizing private capital for infrastructure, particularly around sustainable infrastructure, what do you think the opportunities and roles are there, Sean, from your perspective?
Well, there are two things here to talk about. The first is we should not be building infrastructure. Hopefully, we will not be building infrastructure in the US without a climate filter. And there are two filters that are relevant. One is there's a mitigation filter. We have very tough 2030 goals set by the administration, absolutely correct goals in line with what the IPCC says, and that will require us biasing our whole economic development towards low carbon activities in a wide range of areas. So decisions about infrastructure that's necessary need to be made with those in mind, with those kind of issues in mind. That means, yes, more electric charging points and no fewer petrol or or fuel infrastructure, and so on and so on and so on. But it also applies to adaptation and resilience. You've seen how climate change is impacting around the world this year, with the drought we're experiencing in the southwest, the heat incidences in the northwest, and let alone the fires that are raging in all around the world, including in Siberia and the permafrost now. Climate change has started. So we've got to prepare for much more severe heat incidents, as well as, by the way, snow at crazy times, like we saw in Texas, which blew out the infrastructure. Note that, because it wasn't built to be resilient for extreme volatility. So that's a filter across all infrastructure that we've got to bear in mind. And then separately to that, we've got evidence, thanks to the fixed income market, but it's spilling over, of the investor appetite for green, extraordinary investor appetite for green investment, which is infrastructure that addresses our 2030 goals directly. So that might be wind and solar farms, it might be railway lines, it might be green buildings. In fact, there's all sorts of things. So we have very high subscription rates for green infrastructure, lots and lots of demand. It's a $1.5 trillion market so far. Green and sustainable is nearly $2 trillion. And it's growing. It'll grow 80% this year on last year's figures. So there's two things at play here. One is what we have to do, and certainly what I believe the administration is focused on us doing, thinking about all infrastructure in the context of what we have to do to address the future fit. And then secondly is the thematic benefit for green, which is spilling over into green loans and green equity. I mean, we had Goldman Sachs announce recently they're going to issue some green equity, yet to see exactly what they mean. But the investor appetite is real and palpable. And it's not just Paul. It's all sorts of investors. You know, I was on a panel with Nuveen last week. We were saying, give us green. Allianz Bernstein, BlackRock, PIMCO, they're all the same. Fixed income, the area I'm in mainly, but also other kinds of asset classes. So that's what people have got to bear in mind. And that should change how we execute on the infrastructure go ahead. Now, from a financial scheme, there's an opportunity for blended finance within that. And it's important to note that in the US for the last 200 years, we've built our economy on blended finance, on guarantees especially of various sorts. I mean, the New York and New Jersey Ports Authority is a guarantee vehicle, effectively, using a bit of state guarantee to raise capital to do stuff. But there are many more sophisticated models around. Paul can tell us about them. That's how we're going to do it.
Okay. It was good to start to see some kind of link between the high-level goals that, as you say, the administration is talking about and setting, and I guess will be reflected in COP coming up too, and maybe further commitments, globally will come, and then what it means for investors and their appetite. So we might touch on that again as we go through. But François, I might bring you in here a little. Sean was talking about a bit on the adaptation side. It feels to me like adaptation maybe has been a bit neglected as a investment opportunity. What is the investment case for adaptation? You know, what resilience, I guess, and what is resilient infrastructure? What do you kind of see from your investor members around their attitude to resilient infrastructure?
Yeah, thank you, Eric. I would say that most of infrastructure investors, and particularly long-term infrastructure investors, who share the same long-term DNA as we do in our association, are already pretty much convinced that any new infrastructure investment ought to be resilience and take into consideration adaptation issues. Resilience has commercial value. It's not just about entailing additional cost. It does provide a coverage against future risk over the life cycle of a project, and thus helps achieve more predictable risk-return profile. And in that way, one could say that indeed, for infrastructure investors, it's probably a way to get to the ultimate grail of having infrastructure achieve an asset class status. So the goal, the long-term goal, in my view, is pretty much identified and understood by infrastructure investors. sustainable and resilient infrastructure ought to be the motto right now. And indeed, if the infrastructure were already resilient and sustainable, then the recovery we're talking about would probably happen almost naturally or automatically in a number of sectors. The issue is about the way to get there. And in that respect, as I see it, the kind of feedback we get from our investors, even before getting to the ways and means and how to use blended finance or leverage public long-term financing to facilitate private sector investment, I believe the first hurdle is really about the reaching and achieving a common language. How do we deal with the sometimes confusing and fragmented landscape of tools, frameworks, measures that currently try to define what is sustainable, what is resilient, what is adaptable? The Network for Financial Centers for Sustainability recently identified over 180 such tools and frameworks in the field of long-term investment in infrastructure. It just gives an idea of how fragmented and confusing this can be for infrastructure investors faced with issues about reporting, providing the right kind of metrics and measures to their investors and the broader community. So people like you, Rick, and GRESB are doing a great job in trying to refine and facilitate and sort of standardize this type of measures to help converge towards a common set of metrics. But there's still a lot of work to be done. It might take a long time, frankly. I mean, if we keep in mind for example, what happened in terms of financial accounts, it took decades before the big stakeholders internationally agreed on international accounting standards to be applied across the board, across countries and sectors. Hopefully it won't take so long for infrastructure, but there's still a lot to be done. I would just like to flag a few initiatives that go in the right direction. Fast Infra, for example, an industry-led, market-led initiative trying to better assess and label what is sustainable, what is not. There are initiatives as well supported by the public development banks, Finance in Common, to try and nudge and move the needle in that respect. We may be also through, in particular, initiatives at the European level, which seems to be a bit more maybe advanced in that respect compared to other regions. We may be moving towards a hopefully eventually global taxonomy of what's sustainable, what's not, to inform and help the various stakeholders take their decisions. But again, my view is that it may take time. It still requires a lot of progress to be made and convergence to happen. But the roadmap and the ultimate goal is pretty much now fully mainstreamed by infrastructure investors. The long-term nature of infrastructure investment makes sustainability and adaptation already a key dimension, a key ingredient you cannot overlook anymore.
Absolutely, and you raised some really, really good points. It's certainly, from a GRESB perspective, we're a great supporter of Fast Infra, and I know Sean also been very supportive. Great initiative to start to label infrastructure projects and help that to promote capital going towards those kind of projects, particularly in developing countries and the like, where there's an enormous need for infrastructure spending. And the whole issue of the indicators and metrics is certainly one that we're very active in, and trying to align to the various metrics and frameworks that come out as they evolve. And we're very closely watching the work of the various boards that are looking to converge, as you say, François. I might move on to something Paul and I were discussing earlier, was the parallel perhaps of what may be argued is happening now, or is desired to happen now around climate change investing with kind of previous clean tech or green waves early in the 2000s. Then I guess you were relaying to me, Paul, that it was a very exciting time. A lot of capital went into that kind of new investment idea. Do you feel there's a similar concern this time around for climate change, or are you kind of more with the positives that have been just explained by a couple of the speakers, that this time, it is very different, and I can imagine there are a bunch of reasons for that. But yeah, what's your kind of view on that comparison?
I certainly, would agree that there's a lot of very interesting things that are going on that investors are working on. Perhaps more so on the private equity side than maybe on the infrastructure side. And there's no doubt that some of those things are going to work, but there's going to be ideas and around sustainability that just are not going to come to fruition. And I think the reason I always think back to the 2000 and the kind of the green wave, everybody thought that this was the beginning of what was going to be clean tech. And, that seemed like there were entrepreneurs ready to do great things. There were a lot of great ideas, and a lot of money was lost. And I'm always concerned that you're going to get into a little bit of the same thing. You've got certainly a number of initiatives around carbon neutrality, low carbon solutions. You've got certainly a lot of investors fired up, and you've also got a lot of passionate, social ESG type concerns around that. Not denying that. I think that's all great. It's nice to have all those things, but I'm always concerned that there's going to be, that when it comes to me on the investor side, picking through those ideas, it gets harder. There's passion involved. There's a desire to do something and push things forward, and some of those projects are going to work, and then some aren't. And as an investor, you want to be with all the ones that work. That's just kind of how it is. And so it causes us to be more cautious around those sorts of things in terms of what kind of expected returns we're going to get from that. And again, it goes to the portfolio itself. Who's going to do that? Is that more of a private equity thing? Is it more of an infrastructure project? Where does it fit in the, and we're also, the other discussions around this are, where do these things fit in the portfolio? Now, we've created within our sustainable group, a group that's going to start to look, we call it in-betweeners, tweeners. We don't quite know what to do with some of this stuff. It's kind of like private equity, but it's kind of like infrastructure. It's kind of like real estate. So we've created a group that's going to build on that over the next few years and put together a portfolio of some of those things. So they may end up there. So I'm just, I always, as an investor, I always get concerned when there's a lot of excitement around something that's, and a number of things that haven't been proven. It sounds really great. And so, I'm always just sort of, I'm dubious. And so that's just kind of how we work. In an infrastructure, we're thinking of when someone comes in with a project, they pitch it, I'm immediately thinking, okay, what is going to go wrong with this thing? What is my downside if everything just doesn't work? And I'm looking for a downside return that I'm hoping is going to still not make me look too dumb by doing this investment if it doesn't work out. I don't think a lot about the upside. I mean, the upside is sort of like, okay, that's great. If you do what you're supposed to do, then I'm going to be a pretty happy person. So my approach is a little bit different, whereas the private equity folks are looking for, the upside and everything to click and go. So I think what's going to be incumbent on us going forward is to really pick through projects. And again, by that, I mean pick through projects with our managers. We don't do that kind of work internally ourselves. We rely on our managers to work with us, to talk these things through and do the due diligence side by side with them. Because they're in that market every single day doing, we're hopping from project to project. So that's my concern, is that in what's going on here, it's certainly exciting, and some things are going to work and some things aren't. And the idea that everything should be able to find a home with an investor may not always be the case.
Yeah.
But that's investment, Paul, right?
Well, I think it's a good
investment.
point. I'd open it up. What's different this time? If you think it is different, is there something different about now to that clean tech, that promised so much? And then, as Paul says, people were pretty badly burnt. What's different about this time? I'm sure you've got an answer, Sean.
Well, the difference is we have an existential challenge facing us, and our societies won't exist unless we tackle this. I mean, our kids will not have a future that we want them, that we would be comfortable with them living in. That's what we're looking at. And so there's a bit of an urgency and a bit of a more substantive aspect to it. Tied to that, we have substantial commitments, which, people don't know quite how they're going to do yet. I mean, the US administration, I mean, the European Union, I mean, the Chinese government all have robust 2030 and 2050, 2060 targets. So we have the global economic shift is certainly underway in terms of signaling. So you can expect, it makes a reasonable amount of sense that there's going to be a bunch of stuff flowing out of that. A reasonable chunk of that will be a reordering of capital flows to make them more sustainable. We're not necessarily going to get a lot more transport investment, although we're probably going to get a lot more electric vehicle investment, at least by General Motors and the like. But we are going to get a shift. So capital flows are going to be less on building service stations and more on building charging points. Good news for Megha. That's just going to happen. And frankly, that train has already left the station because we have the cost curve for electric vehicles and the range increase happening so damn fast that in the next couple of years, subsidies gone. Honestly, they'll all be gone because they just simply will not be needed. Whether there's a need to push infrastructure development around electric charging, that's a question Megha might have a view in the short term. But over the next few years, this is going to happen in warp speed. The question is it going to happen in all the other areas of infrastructure quickly enough to avert the catastrophe that Joe Biden has spoken about so eloquently in recent times, more storms like we saw in New York. So there's no uncertainty about the shape of the future now. Let's be clear about that. The uncertainty is the speed of the change, and therein lies the investment challenge. How do you pick things that happen? But unlike some of the other booms and busts we've seen over the last, in my life, the last 40 or 50 years, this is one that will happen. It's just, a question of the jagged line along the way. Change is always jagged, right? It's volatility is baked into rapid change, but the where we're going is very, very clear now.
Can I add something here?
Go for it.
No, I've worked on renewables. I've worked in clean energy policy for the last 13 years, and I've worked on implementing RPS mandates for the state of California before I joined solar and subsequently EVs at that time. So we had renewable energy mandates, like 33% of energy had to come from renewable sources by 2020. So consequently, in California, there was no scope to build a new power plant that was not a renewable. So mandates like this by themselves, driven by what Sean said, the urgency, it's an existential threat, are going to force people to just invest in this technology at this time. Again, looking at California as an example, we talked about electric vehicles, but if you're not going to sell any new electric vehicle post 2035, what's the point in investing in internal combustion engines before that time? You talked about storms in Texas, about climate change, about resiliency. I worked on centralized power procurement, and it's changed so much. Like now you look at distributed assets to adapt to the climate right now. You're looking at more and more rooftop solar. You're looking at rooftop, on-site storage batteries. You're looking at electric vehicles by themselves are big batteries. Like if you have one of these Teslas, you have something that's almost 5 times the size of a Tesla Powerwall right now. So homes have just become power plants because now you're generating power, you're consuming power, you have time of use rates or so. So the whole nature of everything, driven by, a lot by climate change, by renewable mandates, by adoption of distributed generation, has changed what the grid and therefore infrastructure looks like. So there's no room to do anything else. There's no room to do what you've already done in the past because you have to change. Otherwise, you're just not going to exist.
And François, on that kind of definition side, everyone's played with the definition of infrastructure for years, right? And as an asset class, et cetera, et cetera. We've all heard various talks. But does this kind of matter? Coming back to that, in terms of this, what is going to be the role of infrastructure investors in this change? Because some of the issues have been highlighted there. Some of the challenges on infrastructure investors are looking for a low risk, low return. It's very stable to balance their portfolios and so on. And then some of the issues that Sean's highlighted, it's going to be jagged, and that presents risks and returns. But maybe there's a lot of these opportunities are going to pass infrastructure investors by and go to the private equity teams and so on, as Paul or the in-betweeners. Maybe we've got a new asset class arising. But I just wondered on your view on that, on the infrastructure investors. Is there enough certainty in a way about the future for these risks to be low enough that they're attractive to infrastructure investors?
Well, I think we ought to be modest, and I believe indeed that there's no such thing as a certain future, not even in infrastructure. I mean, we all know that the technical disruptions, social or demographic shifts are at work that may fundamentally change the way we behave or consume or use infrastructure services in a way. I mean, these may effectively affect the traditional risk profile. We tend to see core infrastructure in any case, as a rather very low risk and almost boring infrastructure investment asset. This may change. I mean, we've seen already last year with the COVID-induced crisis that assets that we thought were quite safe and reliable over the long term were not immune to significant changes in the economic environment. So I believe we have to effectively admit that there will probably be significant changes, that the long-term sort of recurrent nature of infrastructure income that sort of fundamentally made its appeal to long-term infrastructure may evolve, and not necessarily in the direction we would like it to take. But again, what's the alternative? I mean, for those long-term investors that need to park their money in real assets and somehow protect them or adopt a more defensive approach over the long period, I still believe infrastructure remains a safe or relatively safer bet over the long term. Now, maybe just a very quick reaction to what was said before about the sort of a movement towards green and clean new technologies, and how this could effectively affect the landscape in the coming years. I still have a bit of a concern in that respect. It seems to me there's a disconnect between the speed of technological progress and disruption, as we already mentioned, and the fact that administrative processes, permitting, licensing, land acquisition remain a rather complicated, time-consuming and burdensome process. I'm not a specialist about the US market, but in Europe, we've had this debate recently related to how the EU Invest Plan in the infrastructure sector could contribute to the recovery. And there's an expectation that the money the grants that are being distributed to member countries be spent as quickly as possible. But the fact is that not many of those infrastructure projects, not even in the new tech or digital or green sectors, are effectively in a position, or shovel ready, or in a position to be effectively rolled out very quickly. So this is I believe, an issue we have to keep in mind. It's all well and good to talk about how tech disruption is going to change things very quickly, but there's still this this constraint that I don't see disappearing anytime soon in terms of the time frame needed to effectively engage in those investments.
Yeah, it's a really good point. So go ahead, Sean.
I have to say, just bearing in mind, it is very clear there's an infrastructure deficit in the US, right? I don't think there's any doubt about that. There have been endless engineering reports about bridges falling down and so on. So there's a backlog of investment to be required from North America. And of course, that applies to emerging markets with a different kind of deficit, where we have a whole series of cities of 20 million people being built, all of which are infrastructure poor and have to build infrastructure as they become richer. So the pipeline is clear. There is a pipeline, one. Two is that infrastructure has got to be green for all the other reasons we talked about. And we have a good shot at making that because of the nature of major economy investments, targets, 2030 targets. You put those two things together, something's going to happen. Now, the only question is, how do we make it work for the risk yield requirements of CalSTRS? And that is tough because, of course, we've got to pay pensions here and all this is big and new. Well, there's a very simple way we've done it in the past. And that is risk-taking by public sector institutions or in guarantees. That's how we've done it. That's how we build the bridges of Chicago, for God's sake. It's an old, tried and tested formula. If it's a public policy priority, we will find a way to pick up the risk to make it palatable. And of course, the two levels of risk is a project development, and which we can deal with offtake agreements in some kind of areas or guarantees or long-term return. And then once it's built, it gets flipped over to the investor. There's insatiable appetite amongst institutional investors for long-term, proven, built assets, post-construction, not pre-construction. No way I'm going to be able to convince CalSTRS to invest in something before it's built. They'd tell me, you're mad, get out of here. But there's going to be a lot of stuff built. So there's going to be a lot of stuff able to be flipped to the CalSTRS portfolio in the future. At the first stage, it's all going to be about how we deploy government support. So the US Treasury has made it very clear that development banks now around the world are going to get a mandate from the US board members to support green. And that's going to be risk mitigation measures, not blanket loans. And we're going to see a lot more coming out of Washington, D.C. on that. We are going to see tax credits. We are going to see all the usual measures just rolled out, but they're fiscally efficient measures. That's the key point. So I'm less interested in the trillion-dollar bill blanket funding of things, which I know is a bit of a worry of Paul's. This might actually be the case, because I don't actually see that being the main game here. I think the main game is how the administration is going to leverage what resource it has to grow the pile, because let's face it, the infrastructure deficit in the US is way bigger than 1 trillion. There's a lot to be done. Yeah. And that's what the future looks like. Yeah.
And the mandates and other mechanisms that were mentioned, start to become pretty important by the states and even the local municipalities and so forth. So lots of models there, and we're anticipating them all working to drive it in the right direction. So I think maybe some people are waiting and seeing, and hopefully we see things start to act pretty quickly. One of the ways that investors are trying to drive this agenda is through net zero commitments. There's many have pledged, to net zero, to achieve net zero by 2050, or in some cases earlier, or having interim targets. Paul, I'll ask you first. Setting targets and measuring progress. What are you guys doing? How do you see it?
We just recently made our net zero 2050 commitment. Again, we've been doing climate ESG for the last 20 years, and we had a robust discussion at the board level and staff level about how do we do this. And I think we came up with with 4 Ps: pledge, plan, proceed, and publish. And I think the critical aspect that we're trying to do is, as a teacher fund, we want to research this. We want to do this well. As we all know, there's no perfect measurement system out there, although I'm sure UNPRI and GRESB would say that, they're way better at this and know. But we're actually going to take the portfolios and try to figure out the public side's fairly, I wouldn't say fairly easy, but there's a lot of information there. But when you start to get into private equity, real estate, and infrastructure, there's not as much. and trying to figure out what those carbon footprints look like is going to require a bit more work. So we're going to try it on a portfolio-wide basis and establish a plan, a baseline, and then create a plan over time as to how to bring that down. Now, we can't do it ourselves. Clearly, public companies are going to have to and have pledged to lower those emissions. And then the private entities that we may be involved with may have projects, CapEx, that can bring those down as well. So trying to figure out how to expand that and drive that engagement over the next 30, 40 years and achieve some measurable goals along that is the idea here. So what we're trying to do is establish the methodologies and frameworks. And as we all know, those are going to change over time. Those are going to, it's the classic sawtooth in my mind. It's, things are going to move in fits and starts. But the idea for us was to let's get a baseline created and then see what we can do to improve that over time. So we've established an internal committee to work on this with our sustainable group, and we have representatives from all the asset classes within it. And so we're probably going to be reaching out to our managers, trying to do some estimates around that. We're going to have consultants in to help us because, again, it's one of those things as an investment officer, I know a lot of little things and I can help, but I can't put the big pieces together because someone else who spends their time in that world is going to have to help us do that. And so that'll be our, one of our major initiatives going forward. I think the idea critically around it for us was to make the pledge, but also create the process. And that's what we're going to be doing over the next few years, is creating that process so that we're working towards a goal. It's I think we've called it our North Star. We're going to try to get there. We're going to zig, we're going to zag, but the idea is to get to. And we also say 2050, and you always will see it or sooner, right? I mean, the idea is if we can get there sooner, great, but we want to be able to measure to see that we're making progress with our portfolios at CalSTRS. It was not going to be hey, look, we're going to do this. We're going to measure it, and we're going to be thoughtful about it in terms of that. And as we all know, that this is certainly an industry that's going to continue to grow and expand. And there's a lot of smart people working on solutions and working on measurements to help us to get there. And I think taking advantage of that and trying to figure out how to do that is the best way to get there, rather than just simply to make pledges that sound really good and capture sound bites. So the idea for us was to really dive in, get our hands dirty, and figure out how to get there.
Great, and congratulations also on that pledge, because I know it's very recent. So I think that's great to, as you say, make the pledge and then get on with the job of figuring out, exactly what that means, how you're going to plan for it, how you're going to proceed with it, and so on. So that's fantastic, and that's something certainly at GRESB we're working on. I'm a bit jealous of the real estate team who've made a lot more progress in that area. And there's very good reasons for that. When they've got some pretty good carbon pathways, and they're able to measure progress against pathways and so on in the real estate area. That's something we're very keen to progress further in the infrastructure area as well. Noting that, of course, the infrastructure is an extremely diverse asset class, and what is a decarbonisation pathway for one sector may look entirely different to a decarbonisation pathway for another. So that's a work in progress, and I appreciate your spirit of sort of collaboration, because we're all going to have to learn from each other in this, and that's the way we're going to make progress quickly. Consistent with say SDG 17 about partnering for the goals. That's the only way forward with this sort of stuff if we're going to move at any pace. Does anyone else want to jump in on net zero? Okay, I'll keep moving then. Briefly on we've touched on electrification of transport and e-mobility, and Megha, you mentioned that in your introduction. But what do you think the kind of investor role is in that? You talked about kind of the physical opportunities, and that maybe the initiatives in the infrastructure bill will start to crowd in private capital, but how do you think it's going to work for investors, even if they're private equity? How do you think investors are going to get really involved in the kind of thing you're trying to promote? EV charging, but even beyond that into broader e-mobility.
Well, EV chargers could be immensely profitable. That's what I can say. Well, first off, when you look at investing charges, a lot of money has come in from utility investment. Last year, somewhere in June, around $2.2 billion was just approved in New York and in California, just between two states, towards EV charging or so. And it's going to lead to the installation of a lot of chargers. California has been quite ahead on these fronts. If we look at the United States right now, we have 2 million electric vehicles and about 940,000 are in California. There's about 120 or 130,000 charging ports, public charging ports in the country, and about 75,000 are in California. So there's a huge concentration over there. And it's happened and it's not just because of utility money or there's a lot of government rebates going on, those help, but because there's a bigger concentration of cars there. Private investors, companies like EVgo, Electrify America, their networks are also focused in those areas because that's where the cars are. So it's going to be driven by that. But a very interesting thing about charging is that, and this is something, I work on a daily basis, is that these are not assets that are just gonna, you just install them and then somebody comes and charges and you monetize on that and you're good to go. No, there's a lot more revenue that could come out of it. If you look at it, we have carbon credits that are generated. California has a LCFS market, low carbon fuel standard market. Oregon's developing one. It exists in Quebec. Like in Canada, they're bringing it up. So pretty soon, they'll be trading these carbon offsets amongst each other. Right now, as a charging station, you can sell part of those assets. A level 2 could sell them for you could make about $750 a year. But if you're like one of those larger chargers, it's almost $30,000 a year in carbon credits, which really offset your operating costs. So that's one recurring revenue that you get. Other than that, what we're also working on is making sure that these assets become part of the grid and contribute towards grid resiliency. So there's a lot of things that charging stations can do, like regulation, frequency regulation, and voltage optimization. There's stuff that they can do. The fact is that at a commission level, what we're working on is creating revenue streams. How do we monetize how this asset works? How can it operate in a certain fashion so that you get more revenue out of it? So while charging stations right now might just seem like something that they just charge, as time progresses, they can be monetized for the benefits that they bring to the grid and also important sources of carbon credits, which are getting more and more expensive. In California, they touch $900 per metric ton they're capped, so they almost hit the cap. And places where they're not even uncapped, they could be tremendous sources of profit. So these assets are just going to get more and more attractive to private investors. And
particularly investors who are pledging net zero targets as well. I guess they're going to be particularly attracted to these kind of sources. Yeah.
Right, because right now they just buy a lot of the way that they meet these compliance targets. They say we're not net zero, but we're renewable energies. They're just buying the offsets and the RECs off the market or so. These could be very important sources of carbon offsets too, and we sell them into the market, and it helps companies get to net zero. Exactly.
Great, that's a great example. I might bring in a topic, a little bit of a perennial topic, but we've seen a lot of investors talking about divesting, and we've seen some particular moves around that in recent times with perhaps some colleges in the US, for example. That debate about divestment versus engagement. What's the best approach? And how does that play into things like stranded asset risk and escaping before something becomes a stranded asset? Who wants to touch that first? What is the best approach? And I'm sure you're going to say it depends.
Well, Paul's the one who's got to start this because CalSTRS got a position on this.
He's the investor.
Some of us will weigh in afterwards.
Thanks for that, Sean. We've definitely at CalSTRS have chosen the engagement route. We were successful with Exxon recently, and it's certainly one of the tools in the quiver that we're going to use, along with the pledge that we have. I think our CIO and board members said if you're not talking with somebody, then you're not part of the conversation. And we certainly understand investors that, or not investors, but members of the public and teachers that respond to, you just should cut them off. You should just say no, kind of thing. But we found that by applying continual pressure, and a number of investors across a number of industries applying pressure, plus what you're seeing in terms of continued commitments, are important in order to continue to move the needle towards things like green bonds, to EVs and electric cars, and figuring out how to pay for those and fund them, and then long-term investors like myself and a group, the LTIA, how to get them involved, and their pension funds and or other private investors that have different levels of risk and how they're going to evaluate projects within that. So, it all comes together, it all works, but we all see it within the silos that we operate in. And trying to think about that big picture and how that all kind of blends together becomes more difficult, and difficult to communicate to people in general, I think.
Yeah, and I guess your net zero commitment now, publicly makes your engagement and your conversations different. It brings a whole nother slant to those conversations. Sean, I think you wanted to jump in here.
Look, I want to say my personal portfolio is absolutely stripped of all fossil fuels, and there's a moral position. It's a moral position. But if I want to change things, if I've got heft, I want to engage. If I can own a slice of Exxon and actually engage them, I would say, do it, folks, do it, as CalSTRS has done. And I spoke to one investor recently who had divested, couldn't vote, and was disappointed about it all. So that we're getting to understand, as Paul says, the situation you're in and what you can do. We do have to make a high carbon to low carbon transition really fast, get those companies changing. I'd only say that in the thinking about engagement, we need to understand there are now dead-end investments. They will be stranded assets. A coal plant is a dead end. We will see the wholesale early closures of coal plants around the world in line of what the IEA tells us what to do from 2030. And we will see the wholesale closure of gas plants soon after for similar sorts of reasons. So factor that into your risk taking. Understand that a company that has those, you've got to think of a risk premium on top of them. And what you want to find out about is how quickly they're changing and how quickly you can get them to change. You want to do a NextEra, not an Exxon, or an Ørsted, not a BP. Those new energy companies have overtaken the valuation of the oil companies over the last 12 months. So that's really the engagement strategy here, pushing for real change, not talk, because there's a hell of a lot of pledges that don't mean anything here. And that's the role of the likes of Paul, who've got real heft in the market to drive that change.
Rick, I've got to jump in. The time has landed. And if you could just wrap it up, just a final sentence to tie that wonderful bow together.
One sentence. It might be a long one, but no. Thanks very much to all of the panelists. Fantastic, wide-ranging debate, and it's amazing how infrastructure might sometimes seem like a small asset class in a way, although many assets under management. But there's so much to it in both in the sector diversity, but also the challenges of how do you bring that money to these enormous needs around climate change, around the SDGs. And I think we're all active in this area, and I think the spirit of collaboration shown amongst the panelists, but also in the industry, is something that really keeps me kind of pumped up about the challenges ahead and the opportunities ahead. So let's keep up that collaboration. And with that, I'll draw the session to a close. Thanks again, everybody.
Yeah, thank you. And thank you for that wonderful collaboration, that excellent discussion, moderated perfectly there by Rick Walters, Chief of Standards and Innovation at GRESB. Brilliant. We've got to move it on. As I said, I'm the time police. It's my job. Got to keep things moving on. But big thanks to Rick, and thank you for firing questions our way, for continuing your engagement. Stay tuned. Please submit questions. We love it when you engage with us. Engage via social media as well. You know how to tweet at climate_action_, or you can always use our hashtag #ClimateActionLive, hashtag SINVN